In June 2020, a German fintech worth 24 billion euros told its auditors the cash they couldn't find was sitting in 2 bank accounts in the Philippines. The auditors flew to the Philippines. The accounts didn't exist. 7 days later, the company filed for bankruptcy. And the man who could explain why was already on a private jet to Belarus. Wirecard was founded in Munich in 1999. Its first customers, according to Der Spiegel, were online pornography and gambling websites, the kind of merchants traditional banks refused to touch. In 2005, Wirecard skipped the scrutiny of a traditional IPO. It went public through a reverse merger with a defunct call center company called Infogenie Europe. No prospectus, no roadshow, just a backdoor into the Frankfurt Stock Exchange. By the mid-2010s, CEO Markus Braun had a pitch that German investors had waited a decade to hear. Germany finally had a tech champion, a homegrown answer to PayPal, a fintech that could matter on the global stage. The numbers seemed to back him up. Revenue climbed every quarter, margins expanded, acquisitions multiplied across Asia. The market believed. For American viewers, the DAX is Germany's Dow Jones. The 30 largest companies in the country: Volkswagen, Siemens, BMW, Deutsche Bank. On September 24, 2018, Wirecard joined them. It replaced Commerzbank, a 148-year-old institution, inside the DAX 30. Its shares hit an all-time high above $190. Its market cap briefly crossed 24 billion euros. For a few weeks, a payment processor that started serving porn sites was worth more than Deutsche Bank. $24 billion, more than Deutsche Bank. The fracture started in April 2015, 3 years before Wirecard hit the DAX. A Financial Times reporter named Dan McCrum began publishing a series on FT Alphaville called The House of Wirecard. McCrum's central question was simple. Wirecard kept reporting record profits. So where was the cash? The gap between Wirecard's reported short-term assets and its short-term liabilities didn't add up. Auditable, citable, countable cash kept appearing on the balance sheet, but never quite where you could touch it. On January 30, 2019, McCrum dropped the Singapore exposé. Internal documents, allegedly, showed Wirecard's APAC accounting head Ido Kurniawan instructing staff to forge contracts to, quote, artificially inflate profit. In a single trading day, Wirecard's market value dropped by 8 billion euros. $8 billion. One article. One day. What happened next is, even now, hard to believe. Germany's federal financial regulator, BaFin, did not investigate Wirecard. BaFin banned short selling of Wirecard stock for 2 months, the first time it had ever extended that protection to a single company. And then BaFin filed criminal complaints against the 2 Financial Times journalists who broke the story, Dan McCrum and Stefania Palma. The regulator was protecting the suspect from the reporters. What McCrum didn't know yet was that he was being followed. According to Financial Times reporting, 28 private investigators were deployed against him, his FT colleagues, and Wirecard short sellers under a surveillance program called Operation Palladium Phase 2, allegedly funded by Rami El Obeidi, the former head of foreign intelligence in Libya's transitional government. Wirecard denied any association with the operation. For 16 more months, Wirecard kept growing, kept reporting profits, kept telling investors the missing $1.5 billion wasn't missing. It was just in Asia. In April 2020, KPMG was hired to conduct a special investigative audit. KPMG's report stated, in writing, that it could not verify the majority of Wirecard's reported sales revenue from 2016 through 2018. And it could not verify the existence of roughly 1 billion euros in third-party customer relationships. Then came June 18, 2020. Wirecard announced that $1.9 billion supposedly held in 2 Philippine escrow accounts was, quote, missing. Its longtime auditor, EY, refused to sign off on the 2019 annual report. EY had been confirming those balances for 10 consecutive years. OCBC Bank in Singapore confirmed that neither Wirecard nor its trustee had ever held an account there. The $1.9 billion had never existed. 10 years of unqualified audits. 1.9 billion euros. Zero accounts. On June 19, 2020, the day after the missing $1.9 billion was announced, Wirecard's chief operating officer Jan Marsalek disappeared. According to a joint investigation by the Insider, Der Spiegel, ZDF, and Der Standard, Marsalek allegedly drove to Bad Voslau airfield near Vienna. He allegedly paid the pilots 8,000 euros in cash. The jet flew via Minsk toward Moscow. He has not been seen in public since. On June 23, 2020, Markus Braun resigned as CEO and was arrested by Munich prosecutors on suspicion of market manipulation and false accounting. On June 25, 2020, Wirecard AG filed for insolvency at the Munich District Court. It was the first DAX 30 member ever to do so. 7 days. $24 billion of market value gone. 7 days. From DAX 30 to insolvency. The criminal trial of Markus Braun opened at the Munich Regional Court on December 8, 2022. The indictment alleges commercial gang fraud causing $3.1 billion in losses to lending banks since 2015. Braun has maintained his innocence throughout. He claims, according to prosecutors' filings, to be, quote, himself a victim of fraud. The verdict has not yet been rendered. In January 2026, a Singapore court sentenced 2 former Wirecard Asia executives, R. Shanmugaratnam to 10 years, James Henry O'Sullivan to 6.5 years, for falsifying accounts involving $1.1 billion in fake confirmations. And in March 2024, the same Insider Spiegel ZDF Der Standard investigation alleged that Jan Marsalek had been recruited by Russia's GRU military intelligence on July 6, 2014, aboard a yacht off Nice by a handler called Stanislav Petlinsky. According to the reporting, he was issued a Russian passport in September 2020 under the alias Konstantin Byazov. BaFin President Felix Hufeld resigned on January 29, 2021. He called the scandal, quote, a complete disaster for the agency. Wirecard's lesson is not that fraud happens. Fraud always happens. The lesson is structural. First, an auditor that confirms a cash balance using screenshots supplied by the company being audited is not auditing anything. EY signed unqualified opinions for 10 consecutive years on a number that, according to the bank itself, was never real. Second, when a regulator chooses to prosecute the journalists instead of the suspect, the fraud gets 16 more months to compound. Those 16 months cost lending banks an additional $3.1 billion, according to the indictment. The $1.9 billion never existed. The warnings did. If you want the next postmortem the moment it drops, subscribe. The deeper failures are usually the quiet ones.